Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, May 5th, and I'm recording this from the Milken Conference in Los Angeles, California. It may be hard to believe, but equity markets are essentially back to where they were before Liberation Day tariff announcements. After descending into bear market territory, the S&P 500 has retraced those losses in a remarkable round trip that has left the index down just 3% year to date. Several key factors appear to be supporting the current bullish narrative. First, while uncertainty remains around the ultimate tariff rate, repeated backpedaling and idiosyncratic exceptions by the administration seem to have signaled to investors that we are, quote, past peak pessimism. To wit, despite a current effective tariff rate that is still around 17%, markets seem convinced that the base case of 10% universal tariffs will ultimately prevail, a level that is viewed as digestible by the U.S. economy and sufficient to keep the country out of recession or stagflation. Equally important to investors is the potential for the central bank to accommodate. Although the Fed has been hawkish for most of this year, recent data on inflation and unemployment has raised hopes that rate cuts might be back on the table. In fact, over the past month or so, markets have gone from discounting 2 rate cuts this year now to more than 4. As for the data, both core CPI and PCE readings have suggested cooling inflation, helped along by plummeting energy and oil prices. Meanwhile, labor market weakness has shown emergence, with continuing unemployment claims recently rising to their highest level since November of 2021. Finally, adding to the bullish tone has been solid first quarter earnings results, especially from the mega cap tech stocks. Analysts had originally expected a back-end loaded setup this year, with profits growing only about 5% early on and accelerating to 14% by the end of the year. Instead, first quarter earnings, now about 2/3 of the way through reporting period, are pacing at a 12% year-over-year growth rate, with surprises mainly coming from profit margin gains. Now, importantly, these developments and the bullish argument may be reassuring, but the current dynamic also strikes us as overly optimistic. Markets seem to be ignoring macroeconomic concerns, such as negative real GDP growth and worsening manufacturing orders. Labor markets are showing signs of strain, and confidence among consumers and small businesses remains close to multi-decade lows. Meanwhile, solving America's debt financing problem is far from clear, and critically, forward earnings guidance is weakening, while stock valuations are back near their highs. So with so many moving parts, we remain vigilant and suggest investors stick to their plans, avoiding emotional moves in either direction. Consider maintaining maximum portfolio diversification by asset class, sector, and region. As for the S&P 500, long-term investors should still consider 5,100 to 5,500 as defensible entry zones, as long as a recession is held at bay. That said, equal weighting or active stock picking is still preferred to passive buys. And finally, we have rebalanced our style biases back to neutral, focusing on quality growth names with achievable earnings estimates. In bonds, we see value in the 3 to 7 year maturities, and we suggest scouring the municipal bond sector for opportunities. Thanks for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.